Welcome to Oregon Cash Flow Pro. In today's video, we're going to answer Matt's fourth question. We started off a short series with his prior three questions. If you haven't seen that yet, check out those videos right over here. But this one will be his fourth and final question. So let's get into it. Question number 4. Last idea, why would there be any benefit to front loading and short funding like you would with whole life, and then reduce the death benefit down to a minimum and funding with a small amount for the next 20 or so years, total of 20 years? So good question. The way that it's phrased, I don't remember what video this was on, but it must have been on an IUL video, because he says, like you would do with whole life. You don't have to front load and short fund whole life. Some people do that, especially with our guardian policies, because of the flexibility that they offer and the type of design that we end up with. But you can fund any life insurance policy that way effectively. And there's definitely benefits to doing that. There's also some downsides. So a benefit might be that if you have a lump sum of money that you want to try and get into a policy very quickly, that's one way to do it. We can design it with a higher death benefit to start with, and then that death benefit will reduce it later on when we don't have all of that lump sum of money anymore, and we no longer have the ability to continue contributing at a really high level. What we're always trying to do inside these policies is to run them efficiently. We want those expenses to be as low as we can possibly get in every year, unless it makes more sense not to do that. That might be a little bit confusing. What I mean by that is we may start out with a death benefit that's high to meet a MEC. Let me get a little more specific. We may start out with a death benefit that's high enough that you could put in $100,000 a year, but you don't make enough to put in $100,000 a year for 20 years. You might have a bit of money set aside, so you can pay $100,000 into a policy for 2 or 3 or 5 years. But after that, you're going to be back to relying on whatever your income is, and your income may be substantially lower than that. So let's say after that period, you either can't commit to 100,000, maybe you only want to do 50,000 or 20,000 or 10,000, or you just want to do that. Not even that you can't. Maybe you have the ability to, but you just don't anticipate that you're going to want to do that. Then we can design policies where you're able to put in for that period of time. Now there's a 7-year minimum here before we can make a reduction in the death benefit, which is what changes the MEC limit. So in reality, we may design the policy so that you could put 100,000 in for 3 or 4 or 5 years, but you could continue putting that in for a full 7 years. After that 7th year, it's due to the way MEC limits get calculated. They go on a rolling 7-year time period. But after that 7th year, if you're reducing how much you're putting into it, we can reduce the death benefit. Reducing that death benefit brings that MEC limit down. So the MEC limits will get recalculated because that's a material change in the policy. Anytime we're going to make a change to the death benefit, they'll recalculate the MEC limits and they'll recalculate it at that lower amount. What works without causing a MEC, because you're not going to be putting in that larger amount anymore. That also means you can't put in that larger amount anymore. So if you try to put 100,000 back in there again in this scenario, you would cause a MEC. We don't want that to happen most of the time. This is something that you have to do. This is not a decision you make. We can plan for it, but the actual decision to lower the death benefit and change that MEC is a decision you make in real time. So come year 7 or 8, or whenever we have the plan to make the change, we're going to want to get together and we're going to want to talk about it. We're going to do an in-force illustration. We're going to see, how are you feeling? Because the reality is when we make a change to the death benefit, we're doing it with a goal that impacts our cash value positively in the long term. Well, if for some reason you're not feeling good, something changed with your health, maybe you don't think you've got another 20 or 30 years to live, maybe it doesn't make the most sense to reduce that death benefit. It might actually be better off to have a higher cost inside the policy for a while, but ultimately that higher death benefit is going to pay out sooner rather than later. Those are the kind of decisions that we've got to decide. You're basically going to roll the dice on when you think you might be passing away, and we'll make our goals accordingly. So yes, there's definitely benefit to front loading and short funding the policies. One of the downsides, though, is you can no longer continue funding it at that high level if for some reason you change your mind, because at that point you've adjusted your MEC, and in order to go back up, you're going to have to re-qualify with underwriting. Insurance companies will let you lower the death benefit, no problem. But if you want to raise the death benefit, most likely you're going to have to go through underwriting, because there's always the concern that maybe this person is going to be dead soon, and that's why they want to raise their death benefit. The risks could be completely different to the insurance company, so they'll want you to go through underwriting anytime you're going to raise the death benefit. But great questions, Matt. I appreciate you sending those in. I'm going to continue answering questions that people leave in the comment section. So if you've got any questions, put them in the comment section below. I usually try to answer them in the comment section, even if I'm going to do a video on it, so that you can get something right away, but not always. Just depends on how much time I've got. So I appreciate you joining me. Be sure to hit that like button, subscribe to the channel if you haven't already. We'll see you next time. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.